Hi, welcome back. It's time to move to our Swotlight segment, and the company I will focus on today is Elgi Equipments. The stock has done well in last 1 year, an outperformer with gains of close to 170%. The company is into the compressed air solution space with a wide range of air compressors, and they have a market share of 22% in Indian air compressor market. They are the second largest player in the country, 8th in the world. The global players are large in numbers, and even in India, they have a competition coming on from a listed player like Kirloskar Pneumatic. There's Ingersoll Rand, that is the other player, and global players like Atlas Copco. So let's talk about the supply chain now. They have vendors like ABB, Siemens, SKF, Kubota, Cummins, to name a few, and they supply to companies like Hero, Honda, Hyundai from the auto space. There's Arvind and Dollar from the textile space, ACC, JSW, BHEL, Revlon, Pepsi, to name a few. Now, the company has applications across the sectors. I'm mentioning only some here. In textiles, it is used for spinning, weaving, processing. In chemical segment, it is used in dyes and intermediate sector. In pharmaceuticals, used in blister pack machines, also used in railways and plastic segment. Now, company gets 92% of revenues from compressors and 8% come in from auto equipments. And majority of the revenues for the compressor segments, they come in from export at 53%, and India is around 47%. So the export markets would include Europe, North America, Australia, Southeast Asia, and South Asia, Middle East, and Africa as well. And the auto equipment segment is via subsidiary Elgi, where they enjoy leadership with last known market share of 40 to 45% in garage equipments. And this takes me to the financial performance of the companies. It has been a stable performer, with revenues increasing from 1,800 crore rupees to around 2,500 crore rupees in FY22. Margins have been stable between that 11 to 12% mark so far. And profits, which dipped in FY20, they have been improving, and the base is around 260 crore rupees. Company has rolled out a strategic business plan where they are now focusing more on profitability and returns besides revenues, and they have a target of $400 million for revenues, 16% EBITDA margins, which is a big jump, and return on capital employed at 30%. Not only that, they are also looking at investments in inorganic opportunities with strategic divestiture of non-core portfolios in real estate. So what would be the risk in this case? Company, in its own admission, said that inflation and political unrest could soften demand in FY23, and they do expect costs to increase and freight to remain volatile. In terms of triggers, the growth in compressor market is expected to be strong, as per some reports around 4 to 5%. And they have been expanding in new international markets as well. I said, yes, cost could be a problem for them, but internally, they are looking at cost control initiatives to ensure margins can be maintained. Now, let's talk about holdings. Promoters hold just 31.3% stake in the stock, but some big names are invested here. SBI Small Cap, Parry Washington Fund with around 10% stake. There's Nalanda with 2.8% stake, Al Mehwar at 2.3% stake. So some big names have invested in the stock as well. Okay, with that, we've completely run out of time on this episode of Inside Out. It's a goodbye from Nigel and I, but do write to us and tell us the companies you want to discuss and you want to hear about, and we'll feature these on our show. Thanks a lot for watching us today.